Index funds and ETFs are two of the most popular investment vehicles available to retail and institutional investors today, primarily because they offer broad market exposure, low operating costs, and minimal portfolio turnover. An index fund is a type of mutual fund or exchange-traded fund designed to replicate the performance of a specific market index, such as the S&P 500, the Ibovespa, or the Nasdaq Composite. These funds are typically managed passively, meaning there is no active stock picking involved. Instead, they simply hold all or a representative sample of the securities in the underlying index. ETFs, or exchange-traded funds, also track indexes but trade on stock exchanges like individual stocks, allowing investors to buy and sell shares throughout the trading day at market-determined prices. This structural difference is critical. While index funds are priced once per day after the market closes, ETFs fluctuate in real time, offering greater flexibility for tactical investors. Both instruments aim to deliver returns that closely mirror their benchmark index, minus fees, making them ideal for long-term, low-maintenance investing strategies. However, despite their similarities, they differ significantly in terms of structure, tax efficiency, accessibility, and cost dynamics. Understanding these foundational distinctions is essential before diving into deeper comparisons, because choosing between them is not just about returns. It is about aligning the vehicle with your investment behavior, goals, and constraints. Many investors mistakenly assume they are interchangeable, but in practice, one may be far more suitable than the other depending on your brokerage, frequency of trading, tax situation, and even psychological preferences regarding control and timing. The goal of this session is not to declare a winner, but to equip you with precise, factual definitions so that every comparison in the following sessions rests on accurate, shared understanding. When evaluating index funds versus ETFs, cost is often the first, and sometimes the only factor investors consider, and for good reason. Over decades, even small differences in expense ratios can compound into massive gaps in net returns. Index funds typically charge an annual expense ratio, which covers management fees, administrative costs, and operational overhead, and these fees are automatically deducted from the fund's assets, meaning investors do not see them as separate transactions. ETFs also have expense ratios often comparable or even lower than those of index funds, especially in highly competitive categories like U.S. large-cap equity. However, ETFs introduce an additional layer of potential cost: trading commissions. While many brokers now offer commission-free ETF trading, not all do, and even when they do, bid-ask spreads and premiums or discounts to net asset value, or NAV, can create hidden frictional costs, especially for less liquid ETFs. Index funds, on the other hand, are generally purchased directly from the fund company or through platforms that waive transaction fees, eliminating spread-related losses. Another often overlooked cost factor is the tracking difference: how closely the fund actually mirrors its index after all fees and operational inefficiencies. Some ETFs, particularly those using synthetic replication or sampling techniques, may deviate more significantly from their benchmarks than traditional index funds that hold every component of the index. Tax efficiency also plays a role in effective cost. ETFs are structurally more tax efficient due to their creation and redemption mechanism, which minimizes capital gains distributions, a hidden cost that can erode returns in taxable accounts. In contrast, index mutual funds may be forced to sell holdings to meet redemptions, triggering taxable events for all shareholders. Finally, minimum investment requirements can act as a barrier. Many index funds require initial investments of $1,000 or more, while ETFs can be purchased in single-share increments, making them more accessible to small or incremental investors. So while headline expense ratios may look similar, the total cost of ownership requires a deeper, more nuanced analysis that includes liquidity, tax treatment, and platform-specific fees. Tax efficiency is one of the most underappreciated yet critical differentiators between index funds and ETFs, especially for investors holding these instruments in taxable brokerage accounts rather than retirement accounts like IRAs or 401ks. ETFs are inherently more tax efficient due to their unique, in-kind creation and redemption process. When institutional investors, known as authorized participants, want to create new ETF shares, they deliver a basket of the underlying securities to the ETF issuer in exchange for shares, and when they redeem, they receive securities back instead of cash. This mechanism avoids triggering taxable capital gains at the fund level because no securities are sold, they are simply transferred. As a result, ETF shareholders rarely receive unexpected capital gains distributions, even when the fund experiences heavy redemptions or portfolio rebalancing. Index mutual funds, by contrast, operate differently. When investors redeem shares, the fund must often sell underlying securities to raise cash, and if those securities have appreciated, the fund realizes capital gains, which are then distributed proportionally to all remaining shareholders, regardless of whether they sold anything themselves. This means that even buy-and-hold investors in index funds can be hit with taxable events they did not initiate, simply because others exited the fund. Over time, especially in bull markets or during periods of high turnover, these distributions can significantly reduce after-tax returns. Additionally, ETFs allow for more precise tax loss harvesting. Since they trade intraday, investors can sell at a specific price point to realize losses, then immediately rotate into a similar, but not identical, ETF to maintain market exposure without triggering wash sale rules. With index funds, you are limited to the end-of-day NAV, which offers less control over the exact timing and price of tax-related transactions. It is also worth noting that while both vehicles are subject to capital gains taxes when you sell for a profit, the frequency and magnitude of forced distributions differ dramatically. For high-net-worth individuals, expatriates, or anyone investing outside tax-advantaged wrappers, this structural tax advantage can make ETFs the objectively superior choice, not because they generate higher gross returns, but because they preserve more of those returns after taxes. One of the most tangible and operationally significant differences between ETFs and index funds lies in how and when you can trade them, a factor that directly impacts investor control, strategy execution, and risk management. ETFs trade on public exchanges just like individual stocks, meaning you can buy or sell shares at any point during market hours, with prices fluctuating in real time based on supply and demand. This intraday liquidity allows for tactical decisions. You can set limit orders, stop losses, or take advantage of short-term market movements. For example, buying during a midday dip or selling before a potential earnings announcement. Index funds, however, are priced only once per day, after the market closes, based on the fund's net asset value, or NAV. No matter when you place your order during the day, the transaction executes at that single price, which means you relinquish control over timing and price discovery. For long-term, passive investors who dollar-cost average or rebalance quarterly, this may not matter. But for those who want to respond to market volatility, hedge positions, or implement more dynamic strategies, ETFs offer a clear operational edge. That said, liquidity is not just about trading hours, it is also about depth and cost. Highly traded ETFs like SPY or IVV have tight bid-ask spreads and deep order books, making them efficient to trade even in large size. But niche or low-volume ETFs can suffer from wide spreads and slippage, effectively increasing your cost per trade. Index funds do not have this problem. Since you are always transacting at NAV, there is no spread to worry about. Additionally, ETFs can trade at premiums or discounts to their NAV, especially during periods of market stress or for international funds facing time zone mismatches. While arbitrage mechanisms usually correct these discrepancies quickly, they can persist long enough to impact your entry or exit price. Index funds, priced at NAV daily, eliminate this risk entirely. So while ETFs offer superior flexibility, that flexibility comes with complexity and potential pitfalls that index funds simply do not present. The right choice depends not on which is better, but on whether your investment style demands real-time control or prefers the simplicity and predictability of end-of-day execution. Index funds and ETFs differ significantly when it comes to accessibility and minimum investment thresholds, which can determine which vehicle is more practical for individual investors, especially those with limited capital or those just beginning their investment journey. ETFs hold a clear advantage in this area. Because they trade like stocks, you can purchase as little as one share, and with many brokers now offering fractional shares, you can invest even smaller dollar amounts. For instance, if an ETF trades at $400 per share, you can buy 0.1 shares for $40, making it possible to build a diversified portfolio with very little upfront capital. Index funds, by contrast, often impose minimum initial investment requirements, typically ranging from $500 to $3,000 or more, depending on the fund company and share class. While some platforms waive these minimums for automatic investment plans or retirement accounts, they still exist as barriers for casual or spontaneous investors. Additionally, ETFs are universally available on virtually every brokerage platform, including low-cost or app-based services like Robinhood, Webull, or international equivalents. Index funds, however, are often proprietary, meaning Vanguard index funds are easiest to buy through Vanguard, Fidelity funds through Fidelity, and so on. And while many are available on third-party platforms, they may come with transaction fees or restrictions. Another layer of accessibility involves international investors. ETFs listed on global exchanges can often be purchased by non-U.S. residents with fewer regulatory hurdles, whereas U.S.-based index mutual funds may be unavailable or subject to complex tax reporting requirements like PFIC rules. Even within the U.S., workplace retirement plans like 401ks often include index mutual funds as core options but rarely offer ETFs, simply due to operational complexity. So while ETFs win on flexibility and low barriers to entry, index funds still dominate in employer-sponsored plans and automated investment services, where fractional share mechanics and end-of-day pricing simplify portfolio management at scale. Ultimately, the best option depends on your entry point. If you are starting with $50 and using a mobile app, ETFs are likely your only realistic path. If you are rolling over a 401k or setting up automatic monthly contributions through a fund company, index funds may be simpler, cheaper, and more seamless, even if they lack the headline flexibility of ETFs. Beyond cost and structure, the ease of automation and portfolio management can be decisive factors in choosing between index funds and ETFs, especially for hands-off investors who prioritize convenience and consistency over tactical control. Index mutual funds are generally superior when it comes to automated investing features. Most fund providers allow you to set up automatic recurring investments, for example, $200 every month, without transaction fees or minimums beyond the initial requirement. Dividend reinvestment is also typically seamless and commission-free. Distributions are automatically used to purchase additional shares at the next available NAV, often including fractional shares to ensure 100% reinvestment. ETFs, while improving, still lag in this area. Although many brokers now offer fractional ETF shares and commission-free dividend reinvestment, these features are not universal, and even when available, reinvestment may occur at the next trading day's opening price, not NAV, introducing slight tracking inefficiencies. Moreover, setting up automatic ETF purchases often requires navigating brokerage interfaces that were not designed for fund-like behavior. You may need to manually adjust quantities as prices fluctuate, or risk buying uneven dollar amounts. Tax reporting is another consideration. Index funds consolidate all transactions into a single 1099 form at year-end, simplifying tax preparation. ETFs, especially if you are trading frequently or using multiple brokers, can generate dozens of individual trade confirmations, complicating cost basis tracking and capital gains calculations. Portfolio rebalancing is also smoother with index funds. Since they do not have bid-ask spreads or liquidity constraints, moving money between funds within the same family, for example, Vanguard Total Stock Market to Vanguard Total Bond Market, is instantaneous, fee-free, and executed at NAV. With ETFs, rebalancing requires selling and buying on the open market, potentially incurring spreads, slippage, or timing risk, especially in volatile markets. For investors using robo-advisors or all-in-one solutions, index funds remain the backbone of most automated portfolios precisely because of these operational efficiencies. ETFs are catching up, and in some cases surpassing, but for true set-it-and-forget-it investing, index funds still offer a smoother, more integrated experience. The trade-off is clear. ETFs give you control and flexibility. Index funds give you simplicity and automation. Choose based on how involved you want to be, not on which sounds more modern or trendy. At first glance, since both index funds and ETFs aim to replicate the same underlying benchmarks, their long-term performance should be nearly identical, and in many cases it is. But subtle structural, operational, and cost-related differences can lead to measurable tracking error over time, meaning one vehicle may consistently outperform or underperform its index and its counterpart by small but meaningful margins. Tracking error refers to the deviation between the fund's return and the return of its benchmark index, and it can arise from several sources: fees, sampling methodologies, securities lending, cash drag, and tax drag. ETFs often have an edge in minimizing tracking error due to their in-kind creation and redemption process, which keeps the portfolio tightly aligned with the index without triggering taxable events or forced sales. Index funds, especially those using full replication, also track closely, but when they must sell securities to meet redemptions, they may temporarily hold more cash, known as cash drag, which underperforms in rising markets. Securities lending, where the fund loans out its holdings to short sellers in exchange for fees, can enhance returns slightly, and ETFs tend to engage in this more aggressively than index funds, though the difference is usually marginal. Perhaps the most significant long-term differentiator is tax efficiency. As discussed earlier, ETFs distribute fewer capital gains, which in taxable accounts translates directly into higher after-tax returns over decades. In tax-advantaged accounts, this advantage disappears, and performance differences narrow considerably. Another factor is the impact of fees compounded over time. A 0.03% difference in expense ratio may seem trivial, but over 30 years, it can reduce your ending balance by several percentage points. Liquidity also plays a role. ETFs trading at persistent premiums or discounts can cause short-term deviations, but these usually correct, unless the fund is poorly structured or thinly traded. In well-established, highly liquid ETFs and index funds tracking major benchmarks, the performance gap is often negligible, sometimes within 0.1% annually. But in niche or international markets, differences can be more pronounced due to sampling, currency hedging, or operational inefficiencies. The bottom line, for broad market U.S. equity exposure, you are unlikely to see meaningful performance differences between a low-cost ETF and an equivalent index fund over the long term. But in taxable accounts, international markets, or less liquid asset classes, ETFs may offer a slight but consistent edge, not because they are better, but because their structure is simply more efficient under certain conditions. Always compare specific funds, not categories, using tools like Morningstar or ETF.com to evaluate historical tracking error and total return net of fees. After analyzing cost, tax efficiency, liquidity, accessibility, automation, and performance, the final step is to synthesize these factors into actionable guidelines tailored to your personal investment profile, because there is no universal best choice between index funds and ETFs. Instead, the optimal vehicle depends on your account type, investment amount, trading frequency, behavioral tendencies, and long-term goals. If you are investing in a tax-advantaged account like an IRA, 401k, or college savings plan, and you prioritize automation, simplicity, and fractional investing, index mutual funds are likely your best bet, especially if you are using a platform like Vanguard, Fidelity, or a robo-advisor that integrates them seamlessly. If you are investing in a taxable brokerage account, care about tax efficiency, want intraday control, or plan to implement tactical strategies like tax loss harvesting, ETFs are almost always superior, provided you are using a commission-free broker and sticking to highly liquid, low-spread funds. For small or incremental investors starting with under $1,000, ETFs with fractional share capabilities remove traditional barriers to entry and allow immediate diversification. For high-net-worth investors focused on after-tax returns, ETF structural tax advantages can compound into 6- or 7-figure differences over multi-decade horizons. Workplace retirement plans will almost always default to index mutual funds, and that is perfectly fine since tax efficiency matters less in these accounts. International investors should lean toward UCITS-compliant ETFs or global-listed ETFs to avoid U.S. estate tax exposure and PFIC complications. Behavioral factors matter too. If you are prone to overtrading or emotional decisions, the end-of-day pricing of index funds can act as a useful friction point, preventing impulsive buys or sells. If you are disciplined and want maximum control, ETFs empower you, but only if you understand the risks of spreads, premiums, and timing. Ultimately, the smartest investors do not treat this as an either-or decision. They use both strategically. Hold core long-term positions in low-cost index funds within retirement accounts, and use ETFs in taxable accounts for tactical allocations, sector tilts, or tax optimization. The goal is not to pick a side, it is to match the tool to the task. Whichever you choose, focus on ultra-low fees, broad diversification, and consistency, because over time, behavior and costs matter far more than the label on your investment vehicle. Now that you understand the real differences, not the hype, you are equipped to make a rational, personalized decision that aligns with your financial life. Do not forget to like this video if you found it useful, subscribe for more deep dive financial breakdowns, and drop a comment below. Are you Team Index Fund or Team ETF? And why? Your experience might help someone else decide. See you in the next video.